I think we're set up for another major top and downturn, except
In the stock market.
it should be worse, in the stock market. And I think that's the key factor for gold people to pay attention to now. Because when that guy goes, when the money flees, it goes somewhere else. It has always gone into gold. If you go back and examine .com top, 2007 top, mid-1970s, gold roared up to 1975 while the stock market was getting killed. In fact, it crashed in 1974, the stock market. So total opposites, including back in the 1930s when the Dow dropped 82% between 29 and 32 low. They didn't have gold because it was illegal, but home stake mining traded went up like 1,000% because gold miner. So gold is the alternative. So don't be deluded by tick-by-tick comparisons of, oh, today's down, so is gold. Oh, S&P had an hourly rally, so did gold. Don't get deluded by the micro because the macro is different. And gold is going to get an infusion of new capital by investors who suddenly say, oops, I need to get out of this. And not all the money gets burned up in flames. It moves. Another place it'll move will be T-bonds, and they're already starting to now catch up to what gold has already been saying.
Right.
Money flow.
Right.
That's the other alternative. So anyway, I think that's the thing for gold people to watch now. Crashes are unusual in markets. In 29 we had one. In 87 you had one, but in 87 the crash ended, and that was the end of the correction. Yeah. Because it was only breaking certain metrics, and its annual momentum fell down to support in that crash. So it didn't break that long-term structure. In our case, we have a different situation now. We have the oldest bull market's 15 plus years old. It's 18-fold for the NASDAQ 100 upside since 2009. It's 8 or 9-fold for the S&P. There's no prior bull market excessive top, we call bubbles like the .com, that matches this whatsoever. And so when it breaks, it's going to be nasty because errors occur in such bubbles. Personal errors, investment errors, corporate spending errors. And suddenly when you rip away the fakery, the false notion, the price of money, for example, being artificially kept low for 15 years, even with the recent rate rise they gave us, that still reached levels that if you look back 50 years, you say, that was a rate rise? It's still very low. And 10 of those 15 years, it was zero. Okay, so you talk about drug taking, in the arm, the Fed was providing drugs to the market that was accepting that flow at the time. It would be the stock market. Those things change. Whenever you break the stock market, if you go look, you'll find gold and T-bonds. That's where the money then flows. And you can bet that the Fed is going to turn on the spigot when they get data points that start to show what stock market tops always produce. Negative data points after the fact. And then the Fed will be panicked. They don't want to cut because it's Trump, they don't want to help him out. But they're going to have to. Even their friends won't like it. Academic friends won't like it. You waited too long, guys, Anyway, that's going to help infuse the next more accelerated move in gold.
Let's delve into the intricate dance between stock market dynamics and the performance of precious metals, particularly gold and silver. Historically, these assets have exhibited a fascinating inverse relationship, with gold often serving as a sanctuary during turbulent financial times. Consider the mid-1970s. As the stock market faced significant downturns, gold prices surged, reaching new heights. A similar pattern emerged during the dot-com bubble burst in the early 2000s and the financial crisis of 2008, where gold's value appreciated markedly as equities faltered. This trend underscores gold's role as a reliable hedge against market volatility. In the 1930s, amidst the Great Depression, while the Dow Jones Industrial Average plummeted by approximately 82% between 1929 and 1932, gold mining companies like Homestake Mining experienced exponential growth, with stock prices increasing by over 1,000%. This phenomenon occurred despite the U.S. government's prohibition on private gold ownership at the time, highlighting the intrinsic value investors placed on gold-related assets during economic crises. Fast forward to recent times. As of March 2025, gold prices have surpassed $3,000 per ounce, reflecting growing investor concern over economic stability and geopolitical tensions. The SPDR Gold Shares ETF, a popular gold-backed exchange-traded fund, has seen record highs, appreciating over 15% since the beginning of the year, while major stock indices have faced declines. Silver, often referred to as gold's more volatile sibling, has also demonstrated resilience during market downturns. While its industrial applications can influence price movements differently compared to gold, silver has historically outperformed the S&P 500 in several past recessions, offering investors both a hedge and growth potential. It's crucial for investors to look beyond short-term, tick-by-tick market movements. The micro fluctuations can be misleading, diverting attention from the broader macroeconomic trends that dictate long-term asset performance. Gold's enduring appeal lies in its ability to preserve wealth over extended periods, especially when traditional markets exhibit instability. The current economic landscape suggests that we may be on the cusp of another significant market correction. Factors such as prolonged low interest rates, substantial corporate debt, and geopolitical uncertainties contribute to this precarious situation. In such scenarios, historical patterns suggest a reallocation of capital towards safer assets like gold and U.S. Treasury bonds. Renowned investor Jim Rogers has expressed concerns about an impending severe recession in the U.S., prompting a shift towards precious metals. He emphasizes a preference for silver over gold, noting that silver prices have not yet reached their all-time highs, suggesting potential for significant appreciation. Furthermore, the recent surge in gold prices has been attributed to various factors, including trade tensions and inflationary fears. Analysts predict that gold could continue its upward trajectory, potentially reaching $3,500 per ounce in the near future, as investors seek refuge from market volatility. In conclusion, while the stock market's future remains uncertain, the historical performance of gold and silver during periods of economic distress offers a compelling case for their inclusion in a diversified investment portfolio. As always, investors should conduct thorough research and consider their individual financial goals and risk tolerance when making investment decisions.
Well, actually, as I said, it's done very well versus gold over the last year. It's really not underperformed, as most people think. Why? Because silver has these bigger pullbacks, and therefore, but you measure, if you're an investor, you don't care about this week or that week. You're looking at month to month, et cetera, and maybe you don't even look at it till the end of the month. Say, what happened last month? Okay, and it's very good. But its spread relation to gold is very cheap still. It's 1.14%. Divide an ounce of silver into an ounce of gold. Now, if you go back 50 years and look at each year, how high did silver get on a percentage basis to an ounce of gold in that 50-year period? 20 of those years, it reached at least 2%. Whoa. Okay, if we break out over the near-term action, then we plot it. There's a nice downtrend line on that spread right now that since that October high in silver at 35, the spread made a peak then, and it's created a very clear downtrend structure. So when you break out above it, it's saying, okay, I'm back. Okay, silver's going to outperform. If you just take it from 1.14% up to 2, which is normal, 20 years out of 50 is hardly abnormal.
Right.
And say, I'm back to, normal. That's a doubling of the price of silver in relation to gold. So, over the next year, if it went to 2%, that means if you bought silver, you made twice as much money as you did owning gold. And it could even be more than that. So I think we're in the same situation with silver versus gold and miners versus gold. We're on the cusp of the new money flow, largely from a broken U.S. stock market bubble, seeking alternatives. And frankly, if you do the math, you'll see that silver, it's up around 40% over the last 12 months, February to February, okay? S&P, I just checked, up 16.8%, okay? I thought the stock market's beating the pants off gold and silver, okay?
Right.
Up 16.7% last 12 months, February close to February close. And silver's up more than twice that, and yet nobody's cheering. Silver's a dog. Okay, well, fine, whatever you want. We see it not as a dog, but as a dog on a leash that's ready to run out in front of the mama market and pull the mama market. So that's what we see for 2025 is probably the best place to be.
Now, if you really want to understand the trajectory we're on, you have to zoom out and look at the macro picture, not just the tick-by-tick volatility that distracts most retail investors. Gold doesn't care about your intraday charts. What it cares about is the big money flow. When institutions, sovereign funds, and central banks start shifting capital from risk-on equities into real assets. And when a 15-year bull market begins to crack under its own weight, where do you think that capital is going to go? Just look at the data. In every major market downturn of the last century, gold has either held its value or soared. In 1974, while the stock market was getting decimated, gold surged. In 2000, during the dot-com bust, gold slowly began its grind higher. By 2011, gold had gone from around $250 an ounce to $1,900, over 7 times in just a decade. In 2025, we are setting the stage for an even more exaggerated move. The bubble we're in now dwarfs the 2000 tech bubble and makes 2008 look like a speed bump. The distortions in capital markets, fueled by years of near-zero interest rates, debt monetization, and absurd leverage, are unlike anything we've seen before. Let's talk about silver for a moment too. People like to say silver lags behind gold, and sure, that's historically true. But when silver plays catch-up, it doesn't do it politely, it does it violently. When gold moved from $800 to $1,900 in the 2000s, silver exploded from $5 to nearly $50. That's a 10 times move. Silver is not just an industrial metal, it's a monetary one. And with the silver to gold ratio still sitting at historically high levels, silver is set to outperform dramatically once that money flow starts accelerating. If you want leverage to a rising gold price, you buy silver. Period. It's what I call the slingshot effect. Now combine this with what we're seeing geopolitically. De-dollarization. The BRICS nations are coordinating in a way we've never seen before. They're not just buying gold, they're designing a new monetary system where gold plays a pivotal role. You think they're doing that for fun? They're preparing for a future where the dollar is no longer the sole king of the global reserve currency club. When central banks around the world start choosing gold over treasuries, that's a seismic shift. That's not just about diversification, it's about survival. And make no mistake, this is not a drill. We are already witnessing early signals of this tectonic shift. Physical gold is in high demand. Repatriation is happening at a record pace. Western vaults are bleeding metal into Eastern hands. The spread between paper gold and physical delivery is widening. These aren't abstractions, they're flashing red warning lights. Now let's pivot for a second to something no one talks about, the velocity of money. People love to quote M1, M2, balance sheets and debt ceilings. But what really matters is how fast money moves through the economy. The faster it moves, the more inflationary pressure builds. We've had artificial suppression of velocity for a decade, but that's reversing. Inflation isn't going away, it's just mutating. And gold is the best hedge against velocity-driven inflation. When dollars start to lose trust, not only due to quantity, but due to speed, that's when the smart money piles into gold and silver. The Fed knows this. Why do you think they pretend not to see inflation even when the prices of eggs and insurance are going through the roof? It's not because they're stupid, it's because their hands are tied. They cannot raise rates aggressively again without blowing up the treasury market. We're at a point where the only viable exit is inflation. And if that's the case, gold is not just an investment, it's a necessity. And here's where it gets even more interesting. Gold's revaluation is not just a hypothetical, it's a policy tool, just like FDR did in 1933, just like Nixon did in 1971. When you're drowning in debt and your liabilities are unmanageable, you reprice the only real asset on your balance sheet that doesn't carry counterparty risk. You reprice gold. It's the one tool in the box they haven't used yet. Now imagine this. What if tomorrow gold were revalued to $10,000 an ounce? That's not fantasy. That's a mathematical calculation based on existing debt levels and the need to backstop confidence in the system. If you think that's too far-fetched, consider this. Bitcoin hit $100,000. Tech stocks are trading at 40 times earnings. Why wouldn't gold, the only asset with 5,000 years of trust, revalue drastically in a time of global monetary crisis? And here's the kicker. The retail investor is not ready. They're chasing Nvidia and crypto memes while the smart money is quietly loading up on real assets. That's how it always goes. The masses get in last. By the time gold is on the cover of Time magazine, it'll already be at $8,000. So my advice to our viewers is simple. Be early. Don't wait for permission from the mainstream. Get educated. Get positioned. Because when this breaks, and it will, It won't give you a second chance to get on board. The market doesn't ring a bell at the top, and it sure as hell doesn't ring a bell at the bottom. It moves and it leaves most people behind. And when gold moves, it moves like a freight train, slow to start, then unstoppable. That's what we're setting up for now. This is not about a speculative trade. This is about wealth preservation, about protecting your purchasing power, and about positioning yourself on the right side of the greatest monetary reset in modern history. Stay alert, stay contrarian, stay ahead. Gold and silver are not just commodities anymore. They are the lifeboats in a sea of debt, derivatives, and deception.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.